the first thing that comes to our mind is that, okay, we have a bullish candle, and then we have the bullish candle opens from the bottom and it closes at the top. You know, someone who's very, very new, this is something very new and I think these basics are really important. So now when you have a bullish candle, it will have two wicks. You know, so when we talk about liquidity wicks and ranges, so this is a liquidity wick. In a bullish candle, a liquidity wick is at the bottom, which means that the bullish candle tried to go down. Let's say it tried to go down, it formed a liquidity wick, which means it grabbed some liquidity or it grabbed some fuel to continue moving up, you know, and then it created a range at the bottom. So whenever a bullish candle is creating a range at the bottom, a range at the top, this means that, okay, now there's a very high chance for the next candle to continue moving bullish, you know, which is why we break down the candles into liquidity wicks and ranges. Next, we have your bearish candle, right? Now, the bearish candle opens at the top and it closes at the bottom. And when we talk about the liquidity wicks and the ranges on bearish candles, we have the range at the bottom because, you know, price is obviously moving down. And then we have the liquidity wick, which is at the top. You know, so whenever you talk about liquidity wicks, these are what liquidity wicks are. Liquidity wicks are basically movements of candles in the opposite direction. That's what liquidity wicks are. I have a little story to tell. My good friend, he started trading in the 1990s. You know, this is a very long time ago. So what they used to do was they used to get prices. You know, they used to get prices every 15 minutes. So now check this out, right? Just like visualize this. So you're there sitting at the screen, you're getting prices every 15 minutes. So let's say that he would get a price, let's say once he get a price and the price would be at, let me just remove this. And the price he would get would be at 100, right? He would get price at 100. And he would write this down, okay, I got a price at 100. And they would have this math paper, you know, that those papers like with boxes on them. So that's what they would have, like grid papers. So he would get a price at 100. And in that 15 minutes or in that 1 hour time frame, he would get a closing price. So he would get an open price at 100, a closing price he would get at 150. Now you have two prices. Now in those two prices, what he would also get is the lowest price. So the lowest price he would get would be 80, and the highest price he would get would be, let's say, 200. You know, so when this would used to happen, they would draw a candle.